The bull market has entered its 10th year, and some of the lasting effects of the crisis are hitting investors right now. Long-term Treasury rates are currently lower than they were in 2008. Federal debt levels have climbed, and the Fed balance sheet is much larger. I want to get to my next guest to talk a little bit more about it. Keith Rosenbloom is Cruiser Capital Advisors managing partner. Great to see you as always.
Great to see you.
Let's first start with the bull market. It's celebrating a birthday, a decade, right? So when you're an investor, you're sitting back and saying typical cycles can be 7 to 10 years. That's what you would expect. But so many people are saying this one is going to last longer. Of which school of thought are you?
So we believe ultimately we're in a bullish entry in the market, but that's being driven by relative values. So if you look at what's been one of the biggest tailwinds here, it's been the cost of money. Cost of money has been really, really cheap. And today, even though maybe many of your viewers don't appreciate it, but 22% of all bonds issued in the world are at either zero or negative rates.
So it's still cheap.
It's pretty cheap. Today, Greece floated a 10-year 3.7% bond. In January, they floated a 5-year 3.6% bond. At Cruiser Capital, we look for really high levels of value. We ain't buying 10-year Greek paper for 3.7%.
Who would?
Lots of people, obviously. The deal will probably be oversold. As I said, there's 22% of all debt globally that's trading at zero or negative rates. So we have a little saying at our shop. It's called "Stupidity is not cyclical." So where you are in the cycle, it doesn't matter that much for opportunities. So we've taken this opportunity to look at how managers and how management teams have used this great access to debt over the last 10 years and what they've done with it. Not just to debt, but all forms of capital. Have they deployed it positively? Have they destroyed value? And that gives us a really good perspective on where we want to be, particularly where we like, which is in industrial land and in chemicals too.
Okay. You're talking about one piece of this, which is, cheap capital, what the Fed is doing, interest rates, et cetera. There's another piece to this picture. It's coming out of Washington. It's trade negotiations. It's, it was a government shutdown and how both sides are going to work together to try to, be a little bit more cohesive in the decision-making process when it comes to running the government. It comes to the president going to Vietnam and trying to negotiate a deal with Kim Jong-un, which was unsuccessful. So many different moving parts right here when it comes to the market. But China right now is one of the focal points. Yeah. And the president is under increasing pressure to make that deal a reality. Right. How does that impact the market?
So I think, first of all, a positive China deal is probably priced into the market right now. That's important to appreciate in terms of where asset values are. But I think one element of this which has not been appreciated at all, which is since this started or since this began, everybody that's doing business in China has looked at alternative supply chains and alternative sales channels, because suddenly you've realized that a major trading partner of yours could have this supply chain and all these billions and billions of dollars of investment disrupted. So you've looked for alternative forms of ways to get there, either to penetrate that market or to get your exports out. I don't think that gets fixed anytime soon. So net, I think actually the US will probably be advantaged in terms of trade, no matter where they settle, and China disadvantaged in terms of trade. But it's a brand new world, and it's an important paradigm. One thing we're looking at is this Cheniere deal, for $18 billion, right?
Natural gas.
That's a big deal.
Huge. And
that impacts a lot of the businesses that we invest in, because natural gas is such an important input to anything in industrial land, but particularly in chemicals. And coatings and things like that.
And it's interesting because you and I were having a conversation earlier, and you mentioned to me that the market may have gotten ahead of itself. It may have beat up some of these stocks in anticipation of a China trade deal that wouldn't be favorable, and really maybe the terms won't be that bad. So there's some opportunity out there.
Yeah, I think so. So for instance, when the whole tariff thing started, if you looked at some stock charts, a company like Cabot, CBT, or like Orion Engineering got totally beat up, totally sold off in very large percentages of its enterprise value because of their exposures to China. If these things get resolved in even a normalized way, we think you'll see very good return of value to where they were. And if you look at Orion Engineering, which we particularly like, people who are investing in the autos, Ford and GM, they're used to thinking about SAR and how many cars are going to be sold and things like this. We look at it a little differently, which is sometimes the components to it are more valuable than the actual cars. What's interesting about Orion is it has 5% of its sales exposed to China, unlike Cabot, which is 25%. So they both sold off. One, we think unnecessarily, and that's what gets us excited if there's sort of some sort of rationalization.
Okay, Fortress Transportation and Infrastructure?
Oh, that's an interesting company too, towards that LNG point.
Right.
So we really like this company a lot. You know, it pays an 8.3% dividend yield. It is effectively a publicly traded holding company that owns infrastructure assets. So presumably the next thing that happens in government is they're going to move to an infrastructure bill. That would be kind of interesting and I think very high level. This company, Fortress, has 4 businesses basically. One is an aircraft leasing business, which generates a lot of value. Its book value is worth more than the current stock price, about $1.5 billion. What's interesting is they have 3 other assets which are related to natural gas, import, export, processing, and other gases and other industrial usage. They think that each of those have values that are well in excess of $5 billion. So in total, today, we get a shot on goal to own something that maybe in 2 or 3 years could have an enterprise value of north of $8 billion. For today, it's something about $2 billion, and we get paid to wait. Again, something that the market sort of presented us because I think of an overreaction to some of these macro headlines.
And that's really the key to this. When you look at the resolution, I think, you know, a lot of people are sort of hunting for opportunity and trying to say, you know, listen, let's put this behind us.
Right.
And sort of patch up the mistakes that we made, own some of these companies, and hope that it benefits both countries as we move forward, Keith, right?
Yeah,
I mean,
I think
that
so.
ultimately would be the best resolution. But
Hopefully we walk away with something that addresses intellectual property.
Right.
Right? Because we all remember, you and I remember Nortel. Right? I mean, Nortel was destroyed because of Chinese raiding, and hopefully this thing comes out tangibly.
hopefully it does.
Yeah.
And the Huawei issues bring that to the table as
Right.
well. Great
That's
to see
right.
you as
Great to
always.
see you.
Thank you so much for stopping by.
Congratulations on the show. This is terrific.
Thank you.
Thank you.
All right.